Hello and welcome to the Currency Exchange, NatWest Markets podcast, where we focus on the currency markets and the major themes and events driving them this week and in the week beyond. Today I'm joined by Robson, who is our co-head of G10 FX. Well, this week was definitely not going to be a boring one, but it actually looks like concerns over banking sector turmoil could actually steal the limelight from key policy decisions. We have both the US Federal Reserve and the ECB making decisions this week. But first, let's look ahead to next week, where we've got the Bank of England, who will be following in their footsteps. Paul, I've got to ask you, do you think that they will kind of echo what we've seen from the ECB and the Fed and kind of, I guess, do a dovish hike?
Well, we think they're going to match the hike that we got from the ECB and the Fed, so a quarter point hike. In terms of the vote count around that, we think it's going to be 7-2. So there are going to be a couple of dissenters, we think, for unchanged rates, but that's not necessarily new information. Of course, as you quite rightly pointed out, it's about the guidance, isn't it? It's about whether you get a hawkish hike or a dovish hike. And, you know, central banks are coming around to the idea that we're very close to terminal rates in the major economies. The problem with the guidance at the moment is I think central banks are struggling a little bit. You had the Ritzbank recently that was super hawkish and then turned dovish. You had the RBA who was dovish and then surprised some people in the market with a rate hike. But in terms of that guidance, if we think about the data that we've had over the last month or so, we've had higher than expected inflation. We had some strong wage data, and some of the activity data has been pretty strong as well. So, for example, today's service sector PMIs were stronger than expected on a revision, and that continues the recent theme of stronger than expected data. And you know, I think that the Bank of England will be a little bit surprised by the strength of the data. So, I think that sort of leans against some sort of definitive move to dovish guidance at this meeting. But you know, the bank has made it clear that they agree with, you know, our in-house economist Ross Walker about the pass-through from the tightening that's already been seen to the household sector is only really partially been seen on the economy. So Ross thinks about 20% of the sort of impact that we're ultimately going to get has been seen. So they'll be confident that further out, the activity data slow, inflation come down, and that probably means that they turn a little bit more sort of symmetrical in their guidance, that, you know, rates might still go up, but equally we are getting to a turning point in rates.
So more pain, unfortunately, in the pipeline for us here in the UK. I guess, what does sterling react to on this announcement? As you said, kind of a dovish hike. Are they expecting a change in guidance, or what's kind of the trigger for the sterling reaction function going into this?
Well, it feels actually on the day it will play a little bit negative for the currency. Markets have got about 75 basis points of tightening before you hit that terminal rate, and our own personal expectation is we get another 25 and essentially they're done. There is a risk that they follow up with a second over coming months, but given what markets are pricing, that should play negative. And the other important thing to note is that sterling's actually been tracking interest rates really a lot more closely than it was doing at the back end of last year. So both euro sterling suggests it should be a little bit lower. Sterling dollar should be a little bit higher on rate spreads. But if you get this dovish hike, I think that does lean against market expectations and plays a little bit more negatively for the currency. Longer term, there's some other important drivers that we think we're going to dominate rather than monetary policy.
I know you always kind of mention the dogs that haven't barked, but to recount your list, what are those kind of big long-term drivers for sterling, and what is it not reacting to or reacting to?
Well, I think some of the story that we've been talking about over the last sort of 6 months, when we published our year ahead all the way back in sort of mid-November, are being sort of better priced in sterling. So the the UK economy outlook isn't as bad as feared, I think is a better understood story. I still think we've got a little bit to go in that story. I still get quite a lot of pushback from my slightly more optimistic view of the economy. Not that the baseline for the economy is particularly good, but the delta on expectations, the change in expectations is very positive because expectations were so poor. So I think that's still got a little bit further to go. So, for example, when we came into the beginning of the year, the market expectation was for the economy to contract a whole percentage point. Just looking at the numbers recently, it's just a couple of tenths of 1% expected decline in GDP this year. I think that ultimately that'll go a little bit higher. But in terms of the dogs that haven't barked that you quite rightly mentioned, there is quite a long list of them. And, I sometimes forget some of them, so I have to write them down so I can remind myself of them. But, just very briefly, things like, people are worried about energy blackouts during the winter and into the spring. That's just not really looks like it's going to happen now. Energy prices have fallen. People worried about storage levels of energy in the UK. That doesn't seem to be an issue anymore. EU trade war fears with the Northern Ireland Protocol being agreed, the Windsor agreement, that's off the agenda. Scottish referendum. Current account funding worries. Well, the current account looks like it's narrowing because energy prices are coming lower. You've got this switch from goods to services. We don't think that's going to be a dog that's going to bark. We haven't really had much turmoil in the gilt market, bond market. Some people are a little bit fearful of that. Housing market, well, that seems to have held up relatively well as well. And even the shortage of tomatoes looks to have bated in recent weeks. So from my side, these dogs that haven't barked, the risk premium in sterling assets, including the currency, just needs to be reduced a little bit further. But as I say, it's a better understood story, but we still think that sterling dollar in particular has upside.
I love that, Paul. So it could have been a lot worse. At least we have tomatoes in our sandwiches here in the UK. I've got to also ask you about the US Fed. So they did kind of deliver a dovish hike, or certainly that's how the dollar took it. Does it reinforce our kind of long-term downtrend view for the dollar?
Yeah, we think so. I mean, our views haven't changed through that FOMC meeting. They raised rates, but I think the guidance around that was relatively dovish, and it plays to this idea that the US economy is just becoming a little bit less exceptional. Right? We keep talking about this, but in terms of relative growth, relative interest rates, there's less support for the dollar here, and valuations are quite high. So the FOMC decided to take the reference out to future tightening. Powell in the press conference was a little bit more hawkish than that. He was talking about inflation and maybe needing to do more to get inflation down, but it feels like the Fed is done. And in fact, our economists have changed their call, and they think that interest rates could be coming lower by the end of the year. So they've put in a 50 basis point cut in 25 basis point increments by the end of the year, having brought that in from the start of next year. But I think the important dynamic and the driver for the dollar that we now need to focus on is just relative credit conditions. And in your opening comments, you mentioned banking sector sort of instability. Whatever you think that's the impact of that is going to be in the UK and Europe and even Asia, it's going to be multiples of that in the US. So this tightening of lending. And if I think about the US or most economies, growth and employment tends to be driven by small and medium-sized enterprises. And the US regional banking sector sort of plays very important part in that. And if that transmission or that lending channel is somehow damaged, then growth expectations will continue to weaken. And I think that plays negative for the dollar, because when we think about what drove the dollar higher last year, it was about this exceptionalism in terms of growth and the Fed tightening, outpacing most other central banks. And that's just not going to be the case, we think, for this year. So to answer your question very succinctly, yeah, we think that not a lot has changed, and we think the dollar continues to head lower, most obviously against European currencies.
And I guess on that note, we have just had the ECB that also seemed to deliver a dovish rate hike, 25 basis points, and the euro was initially trading lower. How do you see that factoring into the euro? Do you think, monetary policy divergence is still the biggest factor driving European currencies?
Yeah, I mean, the outperformance of European currencies, it has been interesting. I think it should be seen separate from the sort of general move in the dollar. It's been very interesting to see that euro dollar has moved higher, while quite a lot of the other dollar exchange rates haven't really moved. So you've had this outperformance. I was actually noting one of your currencies. I was looking at the Polish zloty and seeing against the Korean won, it's sort of done 10% in a couple of months. So I know that EM tends to be a little bit more volatile than G10, but I think that just highlights the extent to which European currencies have been priced higher. Now, a large part of that, we think, is the energy story in Europe. We've been talking about this, but I think it continues to be an important driver. Energy prices coming lower, growth expectations stronger, cost of living crisis a little bit less of an issue in Europe. And Europe was always front and center, always expected to be impacted more than other regions. And as energy prices have come lower, the currency has done relatively well. For the ECB, as you say, we're recording this while the press conference is going on, so we haven't heard the nuances. But it just seemed to be that the ECB was hinting at a further rate hike next month. They were talking about future moves in policy, providing policy to be restrictive enough to get inflation lower, which, when you think about future, seemed to be pointing to some other policy. And I don't know whether it was another classic ECB about balancing the doves who wanted 25, the hawks wanted 50. So you give the market 25, but you sort of hint that you could do another 25. But I think for euro dollar, it's about the cumulative move in rates that we've had over the last couple of months, which is important. So if I look at my charts, look at the relationship between interest rate spreads between the euro area and the US and euro dollar, it suggests that euro dollar should already be trading at 117. So we're quite comfortable with our view that euro dollar ultimately gets to 115 at least. Just one final point on this sort of euro outperformance. Only time will tell if there's something else going on. So we think it's rate spreads, we think it's relative growth, we think it's energy, but whether it's something a little bit more durable, for example, reserve allocation moves. There's not a lot in the IMF COFA data at the moment to suggest that, but only time will tell whether there was this move as well. And also about the move from sort of negative rates to positive rates, whether we're just seeing a rebalancing of capital away from the US and Asia back into Europe, and that's supporting the euro. So watch this space in terms of the drivers of the euro. But as I say, still very much behind the idea of euro dollar upside should be favoured.
Fantastic. Yeah, it's a lot of different drivers. I know definitely in my space, we've seen significant correction in the current account surplus, which is one of kind of the big reasons why we're calling for Polish outperformance. But guys, that's about all we have time for this week's episode of the Currency Exchange. Paul, thank you so much for joining us. If you did like the podcast, please do click like and remember to subscribe so you get the latest episode first. Thanks again for joining us.